Quick show of hands. How many people are familiar with the Guide to the Markets? Okay, a couple of you. So the Guide to the Markets is obviously focused very much on the economy, the public equity markets, the public debt markets. In more and more of our conversations, we've been focusing on less traditional asset classes, namely real estate, infrastructure, private equity, private credit, hedge funds. So we thought that it would make sense to put together this guide to alternatives in an effort to do exactly what we've done with the Guide to the Markets, which is really simplify the complex. So the purpose of this session today is to give you a little bit of a flavor for some of the content that's in the book. The book is divided into 5 sections. We have a bit of an overview section that looks at alternatives in aggregate. We then have dedicated sections on real estate, infrastructure, private markets, and hedge funds, and we produce the book quarterly. So this is the first iteration that I'll be presenting today, or walking through a handful of slides from this morning. The next version is coming out on June 3rd, and we will be doing a webcast on June 5th. So if you're interested in getting that information, reach out to your JP Morgan representative, grab me, I'll be around for a little bit at the conclusion of my presentation, and we'll make sure that you get all squared away with the information that you need. So kicking things off at somewhat of a 20,000-foot view, this first chart just looks at fundraising across the alternatives landscape over the past couple of years. And the growth in interest in alternatives you can't ignore it. You can see it in the numbers here on this page. The majority of this growth, interestingly, has come from private equity, private credit, infrastructure. If you look at real estate, for example, which is that light blue bar, real estate allocations have stayed relatively stable over this time period. When you think about real estate, right, it's perhaps the most established alternative asset class. And so we see people maintaining those allocations. We see fundraising at a relatively steady clip. But again, the growth has really come from interest in private equity, private credit, and infrastructure. That makes sense. Right? In a low interest rate world, people are looking for income. As we'll touch on in a few minutes, that's something that infrastructure can provide. In a world where forward-looking returns for public equity markets are depressed as well, and we touch on both of these themes in our long-term capital market assumptions, people have been looking for a little bit more juice in their portfolios, and again, gravitating towards private markets in an effort to generate that return. I would point out hedge funds. Now, hedge funds is kind of that charcoal color. You see hedge funds suffered from net outflows in both 2016 and 2018. Now, a lot of that was driven by, frankly, relatively lackluster performance. But what I would say is that we believe that the clouds may be beginning to break over the hedge fund world, specifically some of the more quant and macro-driven funds, which tend to benefit in periods of elevated volatility. So there's been a lot of interest in this asset class. As I mentioned, one of the big themes here is that people are looking for yield. What we've done on this next chart from our Guide to Alternatives is simply looked at the yield across a number of public and private asset classes. And you can see of the top 5 asset classes, 3 of those, the top 5 yielding asset classes, 3 of those are alternatives, or direct lending, transportation strategies, and infrastructure. Now, if you look at the bottom 5 yielding asset classes, the lowest 5 yielding asset classes on this page, 4 of them are public markets, right? So not only do we see people reaching for that extra return, but reaching for that additional income is also a big theme across our client conversations as it pertains to alternatives more broadly. Now, obviously, that conversation tends to start with real estate. What we're showing here on the left-hand side of this next chart are cap rate spreads for U.S. core real estate. What I would say about real estate is it's not cheap. It's not as expensive as we've seen it be in the past, but there's certainly not necessarily a value play there, and perhaps for good reason. When you look at vacancy rates across U.S. real estate broadly, and we show that in the top right-hand chart of this page, they're sitting near their lowest levels in almost 20 years. Right, the real estate market has bounced back. The commercial real estate market in particular has bounced back quite strongly over the past decade of economic expansion. And if you were to look beneath the surface, obviously there's some bifurcation there with industrial and office having lower vacancy rates than, say, retail. But in general, we do see a fairly constructive backdrop for real estate overall, and we expect that vacancy rates, assuming the economic expansion continues, for the foreseeable future, we expect that vacancy rates will remain relatively low. Now, a lot of people say, core real estate, it's not really doing it for me. I want value add, I want opportunistic, right? I want a little bit more juice in portfolios. And part of the reason why, in particular, value add and opportunistic real estate is providing a bit more income than its core counterpart is because of what we show in the bottom right-hand corner. And what we're showing in that bottom right-hand chart are construction costs in the United States. You can see that over the past couple of years, construction costs have been trending higher. This is both on the labor and the material side of the equation. And what's interesting is that these higher construction costs, yes, they've boosted the available yields in value add and opportunistic real estate, but simultaneously what we're beginning to see is that those higher yields in core and opportunistic properties are beginning to pull, value add and opportunistic properties are beginning to pull those core yields a bit higher as well. Some of you may have read JP Morgan. We're in the process of taking down our headquarters. We actually can't knock it down in New York City because it's right above the train tracks, so we're taking it down floor by floor. But we've invested a quite significant sum in the building across the street, making it, a new age office building with all of the technology we would like. That building is new. We're obviously rebuilding our headquarters. As rents in that part of New York City rise, all of the buildings, in theory, should benefit. But some people say, you know what, David, I think I'm good on real estate. We have a dedicated allocation. We like our manager. We're comfortable with the risk we're taking. What else can you share with me as it pertains to helping me generate a little bit more income from my portfolio? And that conversation almost naturally leads to a discussion about infrastructure. Now, I think that there's some confusion when it comes to infrastructure, so I just want to be clear. There is publicly traded infrastructure, and there is private infrastructure, unlisted infrastructure. Now, publicly traded infrastructure, I'm not going to knock it, but it's publicly traded. So if one of the things you're trying to do by allocating to this asset class is enhance your income and reduce your overall portfolio volatility, adding more equity isn't going to accomplish that, right? You're just going to increase the amount of volatility of the overall portfolio, which is generated by the public equity markets. When we talk about infrastructure at JP Morgan, we tend to focus more on private infrastructure or unlisted infrastructure. And what I've done on this chart is I've shown the returns of an infrastructure asset index, right? So these are the actual utilities, ports, airports, and what I've done is I've decomposed that return into the share which has historically come from income and the share which has historically come from capital appreciation. And a couple of things jump out at me when I look at this page. The first is that those gray bars, which represent the return that you would have gotten from income, relatively stable, right? Year in and year out, getting around 5-6% yield from this overall infrastructure asset index. The capital appreciation, it ebbs and flows with the economic cycle. To me, that's kind of a nice to have. And so in a world where there's a lot of skepticism around the longevity of this business cycle, I think infrastructure can slot in quite nicely to portfolios, right? If economic growth slows and perhaps the broader business cycle turbulence continues, you're getting that relatively solid stream of income, which can help complement the yield that your existing portfolio is generating. But if the expansion continues into 2020, 2021, maybe even 2022, there is the potential for capital appreciation, and there is the potential for you to capture the increase in length of the business cycle and the capital appreciation that would inherently come with that. Now, within the infrastructure universe, there are all sorts of different types of investments. What we're looking at here is a low-risk infrastructure index. So this is going to be focused on water utilities, power utilities, right? Very rarely do people stop paying their water bill. It's one of the last things usually that they stop paying in an adverse economic environment. If I were to show you a higher risk infrastructure index, that would include things like trade terminals, airports, far more GDP sensitive assets. And if I were to show you that chart, you would see a lot more volatility in the capital appreciation component, still relatively stable income. But my point here is that within infrastructure broadly, There are many different flavors. And so you can allocate in a way that is appropriate for your portfolio, either taking a little bit more business cycle risk, a little bit more capital appreciation risk, and investing in some of those higher risk type of infrastructure investments, or you can play it relatively safe and own the power utilities, the water utilities, the things that should generate that income. And obviously you can see the income stream or the return stream is far more dependent on income year in and year out. Now, we're in an interesting environment because for the past 5, 6, 7 years, everybody has been telling me that inflation is coming, right? And it's nowhere to be found. You heard Jerome Powell a few weeks ago kind of dismiss the fact and say, well, low inflation is transitory. I'm not really sure that given the broader macroeconomic environment, investors should be expecting a whole lot of inflation to just suddenly show up in the next couple of years. But the risk of inflation is still there, and I'm not going to dismiss the potential. And that's the other point that I want to make about infrastructure, is particularly within regulated space, so the regulated utilities, if interest costs go up, if inflation goes up, oftentimes the return on equity that these companies, that these assets are allowed to generate increases as well. So what we've done on these two charts is looked at the relationship between the cost of debt and the allowed return on equity for US utilities on the left, and then inflation and the allowed return on equity, again, for US utilities on the right-hand side. You can see the fit there is relatively tight, signaling to us that if you are worried about higher rates of inflation, or we begin to see signs that inflation may be picking up, infrastructure is unique in the sense that it generates a healthy stream of income, but doesn't expose you to that same interest rate risk or inflation risk as traditional fixed income. So we've started by talking about real estate, infrastructure. These are ways that traditionally investors use alternatives to diversify their portfolio and enhance the stream of income that it generates. I want to switch gears here and talk a little bit about what we're seeing across the private markets. Now, the chart on the left here just looks at annual fundraising across private equity in gray and private debt in purple. And you can see, I mean, it's somewhat undeniable, the interest in this asset class and how it's grown over the past couple of years. We were on pace to set an all-time high for fundraising activity in 2018, but as markets became turbulent towards the end of the year, particularly in the fourth quarter, we saw some of that fundraising activity come under pressure, and obviously things shook out at a level much closer to what we saw in 2016 as opposed to what we saw in 2017. But again, the interest in this asset class is undeniable. That chart in the top right-hand corner looks at the number of months it takes to close a private equity or a private credit fund. You can see that those numbers have been steadily coming down over the past couple of years. Looking at the bottom right chart, now this is one of the risks. We've seen all of this interest. We've seen fundraising activity steadily increase. We've seen the amount of time it takes to close a private equity fund steadily come down, but companies, private equity funds, don't necessarily have anything to do with the money. And you can see in that bottom right chart the increase in dry powder that's been observed across both private equity and private credit over the past couple of years. Now, to me, this isn't a reason to say, you know what, too much risk here. I'm done with private equity. I'm not doing private debt. I'm going elsewhere. To me, this is a reason to just be a bit more thoughtful about how you allocate to the space. And what I would say is that the majority of this dry powder is concentrated in the mega buyout funds, right? The $20 billion vehicles that we're seeing being raised, that's where we're seeing this dry powder show up. When we look at smaller deals, smaller companies, funds that have more of an owner and operator type of mindset, we're not seeing the same increase in dry powder. So again, I think that there's reason to be cautious when it comes to private equity, but I don't think that there's reason necessarily to run for the hills. And to me, this next chart really sums up the reasons why. The chart on the left-hand side looks at the number of publicly traded companies in the United States. You can see that that number has nearly been cut in half since the late 1990s and early 2000s. So the investable universe, the public investable universe, has simply gotten smaller over the course of the past 20 or so years. And so the answer to that question isn't, well, I'm going to fish in a smaller pond. The answer there is that, okay, I'm going to go and I'm going to look in the private markets. And when we look at the chart on the right-hand side, which looks at the return from private equity, those are the purple bars, and then something called the public market equivalent, which is the orange dot. And basically what that is if you took the cash flows that went into private equity and invested them in the public markets, this is the return that investment would have generated. You can see that for the better part of this chart, right, the purple bars are higher than the orange dots. That represents the illiquidity premium. And over the period we show, back to 1993, the illiquidity premium here has been about 500 basis points on an annual basis. Now, you'll notice on the far right-hand side of this chart, that illiquidity premium has begun to disappear a little bit. And we get a lot of questions as to why that might be the case. I don't think that the nature of private equity is changing. I don't think that the illiquidity premium is necessarily going to be gone forever. But what I do think is that keeping interest rates so low for so long does allow companies to stay afloat perhaps longer than they should. And so to me, this deterioration in the illiquidity premium that's been observed over the past couple of years in particular is directly attributable to quantitative easing and zero interest rate policy. My expectation, my investment thesis, is that as interest rates move higher, and this is over the next 5-10 years, I'm not going to speculate on what the Fed is going to do over the next 6 months, but as interest rates gradually move higher over the medium to long term, I expect that illiquidity premium will reassert itself. And again, despite some of the risks that we're seeing in private equity at the current juncture, we believe that investors will be rewarded for taking on some of that risk over longer periods of time. Now, where we are a little bit more nervous is in the private credit space. And I want to start by setting the stage in the sense of, what is private credit? Well, private credit is this nebulous term that gets thrown around. Basically, it's not publicly traded fixed income. And we use the leverage loan market as a proxy for private credit broadly. And you can see how the structure of this market has changed quite drastically over the past 25 years. So if you start at that bar on the far left-hand side, you can see that back in 1994, about 70% of lending was done by banks, 30% was done by non-bank companies and funds. Over time, that share has gradually shifted, and in 2017, we just got the 2018 data in the door, but in 2017, what we saw is that 90% of leverage loan issuance was done by non-bank companies and funds, and only 10% was done by the traditional banking sector. So the structure of this market has changed quite significantly. And as the structure of this market has changed, what we've noticed is a deterioration in the underlying credit quality of the loans that are being extended. And the chart on the right-hand side here, those gray bars represent the share of covenant-light loan issuance each year back to 2007. You can see in 2018, approximately 80% of leverage loan issuance last year was cov-light. Again, not a reason to run away from the asset class, but a reason to be particularly thoughtful as you do your due diligence and as you interview managers if this is an asset that you're thinking about adding to your portfolio. Now, complicating things a bit further is the fact that, according to the Bank of England, about $800 billion of leverage loans were issued last year. And of that $800 billion, the Bank of England estimates that 60% was used for M&A and LBO activity. So you're seeing a bit of a feedback loop begin to emerge between private credit and private equity, where the private credit firms are lending to sponsored-backed companies, or perhaps in some cases even lending to the private equity firms themselves, creating a bit of a risk from where we sit, particularly if the economic cycle were begin to sour. Now, $800 billion, right? Let's put it all in perspective. We're not talking about the same type of systemic threat that existed in 2007 and 2008 with respect to mortgages. But I do think that there's a risk here that any downturn could certainly be exacerbated by this dynamic. And furthermore, the gentleman who was just on the stage was talking about ESG. As private debt and private credit has continued to make its way into more and more institutional investor portfolios, you wonder about the social impact if all of a sudden those loans that you thought were worth 100 cents on the dollar were only worth 30 cents of the dollar because the economic tide had turned. Again, we see room for private credit in portfolios. We believe that direct lending can provide a healthy stream of income and reduce a portfolio's overall volatility, but we are a little bit cautious. And particularly when people tell us, well, if you look at 2008, private credit did just fine. Well, if you look at 2008, a lot of people stopped marking their books, so that's part of the reason why it did okay. And also, this is an asset class that's only been around for really 15 years. The data only goes back to the early 2000s. Given the proliferation and the growth in private credit, particularly over the current cycle, I believe that some caution is warranted, and I believe that things could play out a bit differently than what we saw during the global financial crisis. So we've talked about interest in alternatives and how that's grown over the past couple of years. We talked about the two reasons why people have embraced alternatives over the course of this cycle, namely an effort to enhance the income that their portfolio generates, or an effort to generate a little bit more return, and how real estate and infrastructure can help with that income and diversification component, while things like private equity and private credit can more help enhance the overall return stream that the portfolio generates. I want to conclude by talking a little bit about what we're seeing in the hedge fund space. And before we dive in there, I want to talk a little bit about volatility. Now, again, I said I wasn't going to speculate on what the Fed is going to do over the next 6 months, but what I will say is that there is a clear relationship between market volatility and interest rates. And what we've done on this chart is shown the Fed funds rate in orange, and the VIX in that brownish color. And we've led the Fed funds rate. So you can see that volatility follows interest rates with a lag, right? As interest rates move higher, volatility tends to follow suit. Now, it does feel like perhaps the Fed has paused, right? I was earlier this year quite confident that we were going to see at least one interest rate hike in 2019. Now I'm not feeling quite as confident, particularly given the heating up of trade tensions that we've seen over the past couple of weeks. I think the Fed is very sensitive to the impact of that dynamic on the equity market and will likely remain on hold in an effort to keep asset prices and the economic expansion relatively stable and gradually trending higher. But I don't think the Fed is done. I don't think the Fed is done for the cycle. I think we've got a few more rate hikes coming. Again, maybe not this year, maybe beginning of next year. But in an environment where the Fed is moving rates higher and other central banks will eventually be forced to follow suit, this higher interest rate, higher volatility environment can actually help support better hedge fund performance going forward. So this chart on the left-hand side, what we've done is we've looked at the average return of the broad hedge fund index under periods of different volatility. So you can see we move in 5-point buckets starting with below 10. I would actually ignore that because there's only 2 observations below 10. But if you look at the general trend of the chart, what you see is that higher volatility tends to lead to better hedge fund returns. And something we're doing in the next version of the Guide to Alternatives, which again is going to be released on June 3rd, is we've worked to decompose those returns into alpha and beta. And what you see is that even in environments where hedge fund performance turns negative, namely when the VIX is above 30, it is possible for volatility to get too high. You do see that alpha component remain positive. So we believe that as interest rates continue trending higher, that as volatility follows suit, the clouds should begin to break over the hedge fund community more broadly, and our expectation is for better returns from this asset class going forward. Now, with all that said, I have a colleague who always likes to remind me, David, not all hedge funds are created equal. And that's a very fair point. Right? Equity long short is very different than systematic, which is very different than macro. So when we think about the types of hedge funds that stand to benefit in particular from higher volatility, we think that, again, those quant strategies, those more macro-driven strategies are really in a position to do quite well. And what we've done in the chart on the right-hand side is looked at the relationship between the VIX, which is the blue line, and then the relative performance of macro funds compared to the broad hedge fund benchmark, which is the brown line, you can see that the two lines track each other fairly closely. Higher volatility backdrop is generally supportive of outperformance, again, by those more macro and quant-driven strategies. In terms of equity long short, I know that that's another part of the hedge fund universe that's gotten a bit of a bad rap over the course of this cycle. I don't have the chart in the presentation here today, but another chart that we have in our guide to alternatives simply looks at the relationship between the interest rate paid on cash and the performance of equity long short hedge funds. And you can see that there's a positive relationship there. Namely because when a hedge fund shorts something and they need to post that collateral, well, that collateral usually earns the prevailing cash rate. When the cash rate is zero, that means hedge funds aren't earning really anything on that collateral they post. But again, as cash rates trend higher, and we've certainly seen the short end of the curve move higher here over the past couple of quarters, those higher short-term interest rates, I believe, will provide an additional boost to long-short hedge fund performance going forward. So we've covered a lot today, and we've talked about how the interest in this asset class has grown. We've talked about some of the themes that we're seeing in the real estate sector, the infrastructure sector, some of the risks, but also some of the opportunities across private equity and private debt. And then finally, we discussed why we believe the clouds may be beginning to break over the hedge fund community more broadly. I want to wrap up with this final chart, which, to put it simply, manager selection matters. What we've done here on this page is shown the spread between top and bottom quartile performance, top and bottom quartile managers in public markets on the left-hand side, and then moving into increasingly illiquid private markets across the chart to the right. Now, it's funny because when people's large cap equity manager underperforms by 100 basis points, you get all bent out of shape. But what you see is that the dispersion of global equity or global bond managers, frankly, is pretty tight. The hedge fund community, which we show in the center of the chart, well, that dispersion gets a little bit wider. And then as you move to the far right-hand side and look at things like non-core real estate, private equity, and venture capital, you see that the difference in performance can be quite significant. Picking the right private equity manager over the past 5 years would have given you a return of close to 22%. Picking the wrong private equity manager, and this is based on the Cambridge universe, would have given you a return much closer to zero. So while in public markets, I understand the move towards passive and a focus on fees. To me, the more fertile playing field for active managers is now the private investment universe. So with that, I want to thank you all very much for your attention this morning. Again, the next iteration of the book comes out on June 3rd, webcast on June 5th, and hope you enjoy the rest of the conference. Thank you very much.